let's say, but it is a feature, means features of CFDs you would see similar with the derivative contracts, because derivative, it means it's a contract of financial instruments, right? Derivative, it means it's a contract of financial instrument. Here also we are contracting the same, means the counterparties that they are ready to sign the contracts with the counterparts. But how the derivatives and CFDs are different, I'll tell you that. Let's say the price of Wipro securities, which is at here now, right? Let's say buyer is expecting upward trend and seller is expecting downward trend. If they're expecting upward and downward trend, then they'll reach to the broker who is offering the CFD facilities. They'll sign the agreement, right? So date will be defined. Let's say date is defined, that is 13th of June, right? So this particular contract, let's say, executed today at, or maybe let's say on Monday. The Monday price we are expecting 400, assume it. Then here you can initiate the contract initiation. Contract initiated. So within, let's assume it, within next 30 days, price will reach to the 450 here. If the price reach to the 450, then on the closing date already it will be defined in the contract, because it's a contract for CFDs, contract for differences. You don't need to exchange any amount, you don't need to pay any premium, you don't need to pay anything as such. So what you need to do, you need to just pay, means counterparties need to pay only the difference between closing or opening price and closing price. So this initial 400 becomes the opening price, and 450, if that price reached to the 450, assume it is reached already, then price, here this price you can call it as a closing price. The difference of opening price and closing price, if you see, contracts open at 400, close at 450, the difference is 50. So it means buyer is in profit. So seller will pay the 50, the difference of 50, right? Closing price and opening price to the buyer. So here the fund, let's say you're working for XYZ fund, and XYZ fund was a buyer of CFDs. So that XYZ fund will receive incoming wire of 50. So it means seller will transfer the 50 rupees through wire payment, and that fund will receive 50 as the incoming wire. So here, in terms of even accounting also, you don't need to do the accounting for this. It is just the contract mark price, and this close is the accounting date price. So on accounting date, price was raised to the 450. So opening minus closing, if you do, so you have a 50 rupees as a profit or gain from this particular contract, and that difference you can adjust as a revenue, means buyer will adjust as a revenue from the CFD, contract for differences. So here it means you can sign the contracts without paying anything, because in our options we pay the margin, in our futures we pay the margin, swaps we don't pay anything, but there would be underlying something, so you should have a loan and all, then only you can sign the swaps contracts. But here Whether you have a underlying or not, that's fine. You can still sign the contract. You don't want means any counterparts. Let's say you're not interested in buying the securities, because if you purchase it, then you require full amount. So you don't want to buy it, but you're looking for exposure. Without holding any securities, you can sell the securities. Without holding any securities, physical securities or even digital securities, you can still hold the rights of that security. It's not something rights, but both the counterparts, they'll agree with their terms at one price, and on a closing date, they'll also evaluate that price with the initial price, and the difference will be exchanged. So here on 13th of June, 50 rupees difference that will exchange. Buyer will record as a revenue from the CFDs, and seller will record the expense from the CFDs. So this is how CFDs works in a fund accounting also. Contract for differences. It's a contract signed to gain the difference of prices of indices and securities. All right.
So, like, suppose if in between also if it reach 450, can I sell and come out, or like I need to wait till the maturity date?
Till the maturity date.
Okay.
If we break the contract, then ultimately it will penalize to the counterparts.
Okay. Okay.
When we say contract, it means you agreed with the terms, you signed it, and then after the contract initiated, right?
Hmm.
If the contract provides you provision or the section, or let's say terms, where you can break the contract at any point in time without paying any additional penalties, then that's fine. But I don't think so. It's a huge risky one, kind of derivatives. So you cannot break that. If you break it, then ultimately it will penalize to you. And that's what it's a contract. When we say contract, it means this contract conditions are abide to the both the counterparts, not only
Okay.
one buyer or seller. Both the counterparts will be entitled to follow this. Okay.
Okay.
Let me come to our main point. But yes, I would request you to please go through that blog. I have sent a link with you. Just go through it if you can.